Three numbers shifted in October that made economic forecasters suddenly nervous. Consumer spending dropped for the first time in 7 months. Job openings fell to their lowest level since 2021. And credit card delinquencies just hit a 12-year high. Individually, any one of these might be noise. Together, they form a pattern that economists recognize. These aren't abstract statistics. They're early indicators that can signal changes coming to your job market, your borrowing costs, and your purchasing power. Understanding what's happening right now means you can prepare instead of react. Economists don't predict the future by gut feeling. They track specific data points that historically move before the broader economy shifts. These are called leading indicators. Think of them like the check engine light in your car. It comes on before the engine fails, giving you time to respond. The most reliable leading indicators include consumer spending patterns, unemployment claims, manufacturing activity, and something called the yield curve. That last one sounds complicated, but it just measures the difference between short-term and long-term interest rates. When short-term rates are higher than long-term rates, it's called an inverted yield curve, and it's preceded every recession since 1969. Consumer spending decreased by 0.3% in October, the first monthly decline since March. That might sound tiny, but consumer spending represents about 70% of the entire U.S. economy. When Americans collectively pull back on purchases, businesses respond by cutting costs, which often means reducing hours or slowing hiring. This particular drop happened even as wages continued growing, which tells economists that people are choosing to save more rather than spend more. That shift in behavior often precedes economic slowdowns. Job openings dropped to 7.4 million in October, down from over 12 million in early 2022. That's still above pre-pandemic levels, but the trajectory matters more than the absolute number. Fewer job openings mean workers have less leverage to negotiate raises or switch to better positions. Meanwhile, the ratio of job openings to unemployed workers fell to 1.1 to 1. Translation: there's now barely more than one open job for every person looking for work. For context, that ratio was 2 to 1 just 2 years ago. A cooling labor market doesn't automatically mean mass layoffs, but it does mean the power dynamic between employers and workers is shifting. In early 2007, similar patterns emerged. Consumer confidence started slipping. Job growth slowed, but remained positive. Credit card delinquencies began climbing gradually. Most people didn't notice because unemployment was still low and stock markets were still climbing. By December 2007, the economy had already entered recession, but it wasn't officially declared until a year later. The lesson isn't that we're definitely heading into recession now. The lesson is that economic shifts happen gradually, then suddenly. The signals appear months before most people feel the effects in their daily lives. Americans now carry over $1.1 trillion in credit card debt, the highest level ever recorded. More concerning is that delinquency rates, meaning people falling 90 days or more behind on payments, jumped to 3.1%. That's the highest since 2012. Rising delinquencies suggest more households are stretched financially. When people can't keep up with minimum payments, it often means they're running out of cushion, which makes the entire economy more vulnerable to shocks. The Federal Reserve raised interest rates from near zero to over 5% between 2022 and 2023, the fastest increase in 4 decades. Higher rates were meant to cool inflation by making borrowing more expensive. That policy works with a lag, meaning the effects show up months or even years later. Mortgages, car loans, and business loans all got more expensive. Companies that borrowed heavily now face higher costs when refinancing debt. Consumers with adjustable rate products see monthly payments climb. Some economists worry the Fed raised rates too far, too fast, and the full impact hasn't hit yet. Others think the economy is resilient enough to handle it. Nobody knows for certain, which is exactly why these indicators matter. The manufacturing sector shrank for 4 consecutive months, according to the Institute for Supply Management's index. Any reading below 50 indicates contraction. October came in at 46.7. Manufacturing often serves as an early indicator because businesses reduce production before they reduce workforce. Factory output tends to slow when companies see demand weakening. This doesn't mean products disappear from shelves. It means production schedules are being trimmed, overtime hours are getting cut, and new orders are declining. These shifts ripple through the economy because manufacturers employ millions of people and buy from thousands of suppliers. Consider what these trends mean practically. If you're planning to buy a house, prices might moderate as demand cools, but mortgage rates remain elevated. If you're in the job market, there are still openings, but you might have less leverage negotiating salary. If you carry credit card debt, rates are near 20% on average, the highest in decades. If you're saving, high-yield accounts finally pay over 4%, which hasn't happened since 2007. Economic shifts create both risks and opportunities. The key is understanding the landscape. One approach some people take is building larger emergency funds when warning signs appear. Another is focusing on paying down high-interest debt before rates potentially climb further. Economists talk about a soft landing when the Fed successfully slows inflation without triggering recession. Think of it like landing an airplane. A hard landing means a crash, high unemployment, widespread business failures. A soft landing means inflation comes down, the job market cools slightly, but growth continues. Historically, soft landings are rare. The Fed tried in 1994 and succeeded. They tried in 2018, and the economy slowed sharply. The challenge is that interest rate changes affect the economy with unpredictable timing and intensity. It's like steering a massive ship with a delayed rudder. Many economists currently believe we're on track for a soft landing. But the data points we discussed are why some remain cautious. Many financial advisors point to several personal indicators worth monitoring, regardless of macro trends. First is your emergency fund. Conventional guidance suggests 3 to 6 months of expenses saved. In uncertain times, some people aim toward the higher end. Second is debt service ratio, meaning what percentage of your income goes to debt payments. When that percentage climbs above 40%, financial flexibility decreases significantly. Third is career diversification. This might mean developing skills that translate across industries or building side income streams. None of these actions require predicting the economy perfectly. They're about positioning yourself to handle multiple scenarios. The personal savings rate, meaning the percentage of disposable income that Americans save rather than spend, currently sits at 3.8%. That's well below the historical average of around 7%. During the pandemic, savings rates spiked above 15% due to stimulus checks and reduced spending opportunities. Those excess savings are now largely depleted for most households. A low savings rate means less financial cushion when unexpected expenses arise or income disrupts. It also means consumers have less capacity to maintain spending if economic conditions weaken. Economic indicators are flashing yellow, not red. Consumer spending declined. Job openings are shrinking. Credit card delinquencies are rising. Manufacturing is contracting. The Federal Reserve's rate increases are still working through the system. These patterns historically precede slowdowns, but timing is unpredictable and outcomes vary. The practical takeaway is awareness. Understanding these trends helps you make more informed decisions about spending, saving, career moves, and major purchases. Economic cycles are normal. Preparation matters more than prediction. Focus on what you can control: your emergency fund, your debt levels, your skill development, and your financial flexibility. Everything covered here is for educational purposes only. This is not financial advice. Every situation is different. Consider speaking with a licensed financial advisor before making any major money decisions.